Okay, this is Order Flow Trading Course Lesson 7, Best Markets to Trade Order Flow. My name is Michael Valtos. I'm the founder of orderflows.com. First, a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. CFTC Rules 4.41 state, hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. Okay, lesson number 7. What are the best markets to trade order flow? Now, there are many different futures markets around the world to trade. Don't feel you have to be limited to trading E-mini S&Ps or crude oil. It seems that, every new trader nowadays just sort of gravitates around minis or crude. Now, the good thing about order flow is the theories and principles can be applied to just about any futures market around the world, from palm oil futures in Malaysia, to DAX futures in Germany, to mini Dow futures in Chicago. Most futures brokers, I'm talking about American futures brokers, and offer access to CME, CBOT, NYMEX, ICE, Eurex, and Life Euronext. Those are the major markets. Those are the ones that you're going to get the best prices on as far as commission rates. But there are other markets around the world to trade. Unfortunately, not all brokers out of the U.S. offer a lot of markets around the world. Asian markets are good. If you're in the USA and you have a day job, you can trade the Asian markets in the evening. But like I said, not all brokers offer the Asian products. It'd be nice if more and more did, but, I don't know, maybe they don't want to stay awake up at night. Now, data providers provide data for Asian and European markets. Kinetic is good, ZQG is good. There's a lot of data providers out there. Just check with your data provider that you're using and see if they have the exchanges that you're interested in, whether it's in Asia or Europe. So I'll start off with the obvious markets. Okay, the most widely known contract is the E-mini S&P, the ES. The tick size is $12.50. The ZN is the U.S. 10-year note. The tick size is $15.62.5. The bonds, the 30-year bonds, is $31.25 a tick. Crude oil futures is $10 a tick. The German Bunds, the FGBL, which is a German 10-year bond, is 10 euros a tick. The Eurostock Index, the FESX, is their most liquid European stock index. It's 10 euros a tick. So these are the main contracts that you should really, if you want to trade the most liquid contracts in the world, that's your starting point. Now, there's Asian markets that you can trade as well. Asian markets are good. I said if you want to start trading and get your feet wet, but you have a day job, and the problem is the U.S. markets in the evening time when they reopen after 5 p.m., 6 p.m. aren't that liquid, but the Asian contracts are liquid, and some have very low tick values that, if you want to just, I'll say play around, but get your feet wet in the markets, you can. So what are the markets? Well, there's the Simex Nikkei, the SGX exchange, they call it now, it used to be Simex. Their Nikkei is $22 a tick. It moves in 5, in nickels, as they would say. So it's like, 97.40 to 97.45. But it's 2,500 yen from 97.40 to 97.45. It's 500 yen a tick, but there's 5 there's 5, I guess, ticks in a point. I guess I shouldn't say tick, but it's more of a point. But one price increment on the chart is about $22. It's 2,500 yen. It depends on the exchange rate. SGX also has this relatively new contract. It started a few years ago. It's called the A50. It's a Chinese lookalike contract. So, there's been a lot of news about the Chinese markets selling off earlier this year, 2016. And, people want to get exposure to that market. Maybe they want to speculate. Most people do. I don't say people are going to hedge their position in China because most people don't have one. But, if you want to have exposure to the Chinese market, you're going to look to this contract, the SGX A50. It has a very small tick value. It's $2.50 a tick. That said, it can have a very wide range. It can move 400 or 500 points in a day. Bursa Malaysia palm oil is 25 Malaysian ringgit a tick. It's quite small now. It's about 5.81. Said that one is dependent on the exchange rate, and right now the exchange rate to the ringgit is the dollar is much stronger. 2 years ago, a tick value was close to $7, and now it's less than 6. There's the Aussie markets, the Aussie SPY, and the Aussie 10 years. The Aussie SPY is their stock index. The Aussie 10-year obviously is a 10-year bond. It's a big contract. It's the 10-year is about $40 a tick, and the Aussie SPY is 25 Aussie dollars a tick. The Aussie 10 years, I say it's about $40 a tick because the way they calculate the tick size is based on the price, and the coupon size is a little convoluted. But, for the most part, it's about $40 a tick. I didn't cover the domestic Japanese markets because it was a lot more trickier to trade those in the past. It may have started to change, but honestly, I don't know. But before, you used to have an account with a Japanese broker. And, if you didn't have an account with, whatever, Daiichi or Yamichi, you couldn't trade it. You'd have to have an account with them, and you trade it on their books. Not like, in the U.S. you can trade through a broker that has a relationship with another broker. I believe that's changed, but unfortunately not many brokers have really sought to add that to their portfolio to offer to clients. The European markets. In Europe, there's basically 2 main exchanges. There's the Eurex exchange, which is based out of Germany, and there's Euronext, which is mainly the British products, and to a lesser extent the French products. I think Euronext has got a lot of relationships with a lot of the minor exchanges now in Europe. But for the most part, the main markets are going to be the German markets, the English markets, and to a lesser extent the French markets. So what do you have? You have the Babel in Eurex, which is a 5-year contract. It's a bond contract. The Eurex Schatz is a 2 years contract. And those are 10 euros a tick. Earlier I talked about the Bund, which is a 10-year contract. The Bund is probably the most popular. Babel and Schatz trade a lot of size as well. The DAX is also a stock index. It moves very fast. It's probably, if you were to say, what does it trade like? To me it trades the way crude oil trades. It moves extremely fast, and if you're on the wrong side, you're going to get your head handed to you. They just came out with a mini DAX last year, late 2015. Honestly, I don't know how it is as far as trading goes, whether it's, there's a lot of volume that's, worthwhile to trade it or not. But it's something, if you're interested, you can look at. The DAX is 12.5 euros a tick. It moves in, actually it's a half tick. So a full tick is 25 euros. Euro stocks, 10 euros, this is Eurex stocks as opposed to Euro stocks. It's 10 euros a tick. It's a different contract. It moves very similar to it, might be a little bit slower. It's a different group of stocks. Then in England, you have the Euronext FTSE, which is 5 British pounds a tick. FTSE obviously is their stock index. Gilts is their interest rate contract. That's 10 pounds a tick. The French contract, the CAC, the Euronext CAC, is 5 euros a tick. Now, just go back. There's a lot of contracts in the United States that, that are there for you to trade. And I talked about the main ones, but some of the less popular ones, but are good contracts to trade, I feel, are the 5-year notes. That's $7.81 a tick. The mini Dow, mini Nasdaq, those are $5 a tick. The Russell Index is $10 a tick. Now, there's some markets. A lot of American markets are open around the clock, pretty much 24 hours. But there's going to be some that have, the majority of their volume is occurring, I feel, is between the 7 a.m. and 2 p.m., the old U.S. trading hours. The markets that I explained before are markets, as far as the U.S. markets, are markets that trade decent volume that you can sort of be comfortable trading with around the clock. But there's other markets that are available for trading in the U.S. that, the volumes during the U.S. hours are much better for trading than necessarily trading overnight or, early morning European hours. And that would be gold, euro currencies, Japanese yen, Swiss francs. Gold's $10 a tick, euro currency, 6.25 a tick now. It used to be 12.5. They reduced the tick size. The yen and Swissy are still $12.50 a tick. Now there's also grain markets, which are they're not as glamorous as, say, trading, the minis or the crude. They move slower, but, it does follow order flow very nicely. It's commodities, so they're going to follow supply and demand. These are products that, they built the exchanges on, and, people need to eat. There's always going to be supply and demand factors for corn, for soybeans, for wheat. These contracts, even though, again, they're available for trade around the clock, I think, though, but the majority of the trading was going to happen during the, 8:30 to 1:15 time, which is the old pit hour session. And like I said, even though they're available for trade overnight, they can move extremely slow. They can move nicely overnight, but it's more often than not they tend to move a lot slower during the night, and the volumes are probably 1/8 of what you'll see during the trading day. The majority of the volume is during the trading day. But the tick size is nice. $12.50 a tick for corn, beans, and wheat. Meal is $10 a tick. That's just the same as, as minis. Minis are $12.50 a tick. So, what to think about when choosing a market to trade? Well, obviously, your main thing that goes into your decision is you're available to trading those markets. If you want to trade, minis, e-minis, crude, you want to be available during the times when it's going to trade the most volume. Next question is where in the world are you sitting? What's your location? If you're sitting in the U.S., it's tough to trade European markets in the early morning. It's a little bit easier to trade, Asian markets in the evening. Do you work a full-time job or not? Can you trade during the U.S. session? If you're in Asia, you can trade, obviously, the Asian products. The European products will open in the afternoon, and you could trade the American products in the evening. But it gets to be late nights. Like now, it's 7 a.m. Chicago time is 9 p.m. in Asia. So you could realistically trade the first 3 hours of the Asian session, before midnight. First 3 hours of the American session, if you're in Asia, before midnight. And you also have to ask yourself, are you an action junkie, or can you exercise patience? If you're an action junkie, you probably want a market that moves fast, crude oil, DAX. If, you're more of a cerebral trader, or you want to think things through, take a more liquid market. Take the 5 years, take the 10 years, take this Euro stocks contract. You have to decide what type of trader you are, or not decide. You have to understand what type of trader you are. Okay, most intraday traders, I don't use the term day traders, I use intraday traders, focus on crude oil or minis. And part of the reason for that, I think, is, there was a lot of volatility in those markets. And, when you have a market that's very volatile, you could throw pretty much any indicator up, and depending on your risk, a lot of trades will make money, and it looks good on a video and on a chart. Say, oh, you'd sell here, and then the market drops. It has $1,000 profit on the trade, and you just see the chart and say, wow, you can make $1,000. Well, that's not really the way to approach the market, but a lot of people do. You see a lot of new traders, they just gravitate naturally towards ES or CL. I think part of the reason is it's sort of forced on them. But, there's really many, many markets out there besides ES and CL. I said, whether it's, Malaysian palm oil or, CAC or DAX or FTSE, Euro stocks, corn, soybean, soy meal, it's a theory of supply and demand. I'm sorry, not a theory, it's a law of supply and demand, not a theory. And, supply and demand has the same effects, whether you're trading pencils, you're trading gumballs, or you're trading batteries, or you're trading corn, or you're trading 10-year notes. So, I'll just run through a bunch of charts here just to show you how things look. This is an E-mini chart. Like I said, it's probably the most common market out there that people trade. And, you're looking for certain things in the chart, where the market turns to go up. Are you seeing anything down here, or are you seeing anything up here? Crude oil, you came down into the low, you have a divergence. I'm going to throw out a bunch of terms here. You're probably not going to understand what I'm talking about till you sort of get through the course. But, why did the market turn here? You have a divergence in, it's not necessarily the strongest signal, but, the market turned there. This is a Nikkei, Simex Nikkei. You have a stack buying imbalance right here as the market is starting to turn around from going lower to higher, and it's acting as support. This is the SGX A50, the Chinese futures contract. And, it's similar to the Nikkei. You're seeing, some aggressive buying come in. You're seeing this level hold as a support level, and the market's trading higher. This is just right off our low, and we're starting to see the buyers come in and pull the market away. This is Euro stocks. You come down into the low, you have a small print here. You get side-by-side point of controls, acting as support, and the market's going up. This is a Bund, German Bund, the 10-year contract. You hit the high, you have a divergence. Maybe you're not yet convinced that this high is going to hold, and you're going to look for confirmation. You have a single print in here, and the market sells off. This is a U.S. bond contract, 30-year. This is a 1-minute chart. You work your way down. You hit the low, and you have a single print. It's the first sign in the order flow on the buy side that the market could be turning around, and the market pops up and goes up. So, I'm showing you examples. This is, a 4-range chart. Here's, a 1-minute chart. That's a 1-minute chart. That's a 1-minute chart. 10-range chart, 10-range charts. I'm showing you how things work on different charts and different setups. You're looking at the same thing, whether it doesn't necessarily matter what contract it is. As long as it trades enough volume that can be analyzed, you can analyze it and make good decisions on trading. This is a 10-year, U.S. 10-year contract. It's a 4-range chart. The market is sort of going sideways here. Then you're seeing, aggressive selling start to come in. You see a small print here. Now you see the selling imbalance. If you weren't convinced that the selling has finally taken over in here when you're seeing this selling imbalance, stack selling imbalance, you can be convinced that the market should sell off. And it does. You can get how many points out of that. This is a 5-year chart, US 5-year chart. We hit the high, okay, you're probably thinking of getting short. It stops here, makes out a new high by a couple of ticks. Okay, now you got it, you sort of got the same setup again. And, you're thinking of getting short. Maybe you're not convinced, but then you have, 2 bars later, another sign to get short. So, and the market sold off. This is corn. It's a 4-range chart. It's the same things you're looking at. You hit the high, you have a divergence. Market sells off. This is soybeans. This is a 5-range chart. Again, you made the new low, this red line. You're hanging around the low. You can't go any lower. You're starting to see some ratios come in. That's what you're looking for the market to start to rally. You get 3 in a row right here. A little pullback, and the market keeps going in that direction. This is a wheat chart. Again, it's a 4-range chart. You hit a high the first time, kind of a weak signal, get short. Maybe you do, maybe you don't. Next, you come back up a little bit later. Now it's really telling you to get short. You got divergence, you got a single print, you got the ratio that you like, and the market sells off. Okay, this is a euro currency chart. This is, again, it's a 4-range chart. You're coming down, 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 down. You hit a low. Boom. It turns right here. Why did it turn? This is what the order flow is telling you something in here. You can see with this ratio, and the market turned and went back up. This is a Japanese yen chart. 4-range chart. You're seeing, imbalances. You're seeing these arrows being drawn here. These are imbalances on the extreme of a certain type of candle, which is telling you, hey, get short. You're seeing a couple together, you should be getting short, after this first one. If you're not, the second one is telling you, hey, idiot, get short. And, the market just sells down, traces it back and continues lower. So, as you can see from the previous charts, order flow can be applied to just about any futures market around the globe, because supply and demand is a law. It's not a theory, right? It's stood the test of time. And, I don't know how else I can convince you. You should understand that, supply and demand works on whatever you're selling, whether you're selling fish. If you're a fisherman, you catch your fish, you want to sell it as soon as you can, right? If you're the middleman that buys the fish from the fisherman, you got to sell it to the people in the market so they can sell it. You're the fishmonger in the fish market, and people aren't buying your fish. You're going to lower the price until you can find people that will buy it, because you know that later the fish are going to be worthless. So you always, you're trying to move your supply, and you're trying to find the level where demand is. So, like I said, sometimes it's best to think of, of trading in non-trading terms. And, then you could really understand it. Whether you're selling real estate, right? You have your house, someone comes up to you with a new listing. They want to sell their house at, $500,000. You think the price is worth, $400,000. But, the sellers don't want to move the price down. So, you try to get them to fix up the property a bit. So, sort of raise the value, but the house is on the market for 3 months. Nobody's buying it. The only way it's going to sell, it, but the sellers don't know it, is you have to lower the price. So this is the end of lesson 7. In the next chapter, I'll jump into understanding order flow analysis and explain what market imbalances are, what they are, why they're important, and how to trade them effectively. So the next lessons from here will sort of take all that I've explained to you earlier and, really start to apply it to the markets. So thank you. That's the end of lesson 7, and we'll begin lesson 8 when you're ready. Thank you.